Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at the Fundrise Innovation Fund.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So let's just get right into it.
Yeah, let's do it. Because, I was thinking, what if the most important wealth-building event of our entire generation is happening right now, behind closed doors, and, well, you are legally not invited?
Right. It's the classic invisible velvet rope in the investing world.
Exactly. I mean, on one side, you have the everyday retail investor. And if you're listening to this, you probably know the drill, right? You play the public stock exchanges, you wait for companies to finally ring that opening bell, and then you buy your shares.
Yeah, you wait your turn.
Right. But on the other side of that velvet rope, you have the ultra-wealthy, the venture capitalists, the massive institutional giants. They are the ones getting access to these exclusive transformational companies. I mean, the foundational architecture of the future years before those companies ever see a public ticker symbol.
And that's the thing. The whole timeline of wealth creation has fundamentally shifted.
How so?
Well, by the time those generational companies finally go public today, the most explosive wealth-building phase, like the massive exponential valuation markups that's already happened in private.
It's already baked in.
Exactly. Public market investors are frequently just buying in at a premium, basically to provide exit liquidity so those early private investors can cash out.
Which is incredibly frustrating for retail investors. But today, we're looking at a mechanism that is basically attempting to cut that velvet rope. We're exploring how everyday investors can actually get access to the absolute frontiers of artificial intelligence and space exploration.
Yeah, holding stakes in the companies genuinely building the future. Companies like OpenAI, Anthropic, SpaceX.
But to really understand this opportunity, we have to establish a pretty major mindset shift right up front for you guys listening. The Fundrise Innovation Fund is not a traditional public stock.
No, not at all.
It's a closed-end interval fund, which means we aren't looking at daily candlestick charts flashing red and green, and we aren't, obsessing over top-line quarterly sales figures. We're looking strictly at net asset value appreciation, or NAV.
Right, and shifting away from that public market mindset is just essential here. When you're analyzing a closed-end interval fund, you have to fundamentally rewire how you think about a company's revenue and growth.
Make that make sense for the listener.
Sure. So for this fund, its revenue, so to speak, does not come from selling a retail product to millions of consumers. Its financial trajectory is derived almost entirely from the structural appreciation of its private market assets.
Right, because they hold private companies.
Exactly.
Yeah.
Because the portfolio is so heavily weighted toward late-stage private AI and space exploration companies, the value is driven by those underlying holdings, expanding their valuation multiples in subsequent private funding rounds.
Okay, let's unpack how that actually works. Because if you're used to logging into your brokerage account and seeing a stock price change every second based on buying and selling volume, the private market feels like a total black box.
Oh, absolutely. It's totally opaque from the outside.
Right. So if there is no daily stock market for a company like OpenAI, how does the fund actually calculate that its net asset value has gone up? Like, how do we know what these illiquid assets are genuinely worth?
Yeah, so the mechanism is completely different from public order books. In the private venture capital world, valuation markups are episodic. They aren't continuous.
Episodic, meaning they only happen during specific events.
Right. So imagine one of the fund's portfolio companies is currently valued at, say, $10 billion. 6 months later, they decide to raise more capital to build a massive new data center.
Okay.
A lead venture capital firm comes in, they agree to buy a new block of shares, and based on the price they pay for those new shares, the entire company is now suddenly valued at $20 billion.
Oh, I see. So the new funding round essentially acts as the price discovery mechanism.
That is the exact trigger. Once that new transaction occurs, the fund relies on independent valuation committees and internal auditors to basically review that new preferred share price.
Got it.
And then they take that new data and officially mark their existing shares up to match the new reality. That mark-to-market process flows directly into the fund's accounting as investment income and unrealized gains. And that is exactly how the NAV climbs without a public stock exchange.
Okay, but the catch here is liquidity, right? Because if you are an investor looking at an interval fund, you might notice you can't just liquidate your entire position on a random Tuesday morning.
No, definitely not.
There's a cap.
Yeah.
It typically allows investors to cash out up to, what, 5% of the fund's net asset value each quarter if they want to?
Yep, that 5% cap is the defining structural feature of an interval fund. And it's important to understand it is a feature, it's not a bug.
Why is that a feature?
Well, think about the public markets. If a really bad headline drops, investors can just panic and sell everything in seconds, which causes a massive crash. The interval fund structure fundamentally prevents that.
It makes me think of like a massive reservoir dam with a controlled spillway.
Oh, I like that analogy.
Right, because the venture capitalists and the portfolio companies, they're building these huge multi-year infrastructure projects in the valley below the dam. If all the investors panicked and pulled their money out at once, it would be a flash flood. It would destroy the companies.
Exactly. It would wipe them out.
So the 5% cap is the spillway. It lets out just enough pressure to give people who need it a structured path to liquidity without draining the lake and destroying the long-term compounding growth of the assets.
That captures the mechanics perfectly.
Yeah.
The fund utilizes that structural stability, the guarantee that they won't face a catastrophic bank run, to confidently deploy capital into these highly illiquid multi-year venture rounds.
Which they need to do to get those big returns.
Right. And furthermore, it allows the fund to maintain really healthy cash reserves. In venture investing, free cash flow is basically your dry powder.
Right, for future rounds.
Yes. When high-conviction winners in their portfolio, like an Anthropic, raise those subsequent rounds of funding we just talked about, the fund uses that dry powder to participate.
So they don't get diluted.
Exactly. This ensures their ownership stake isn't diluted as the company grows exponentially, all while maintaining the necessary liquidity to meet those quarterly spillway releases you mentioned.
Okay, so now that we understand the mechanics of the velvet rope, let's actually look at the VIPs inside the club. I really want to zero in on the most explosive asset currently driving this fund's NAV upward, which is Anthropic.
Oh yeah, massive catalyst right now.
They recently launched a new AI model called Mythos. But they did something highly unusual here. They didn't just release it to the public for a $20 monthly subscription.
No, they didn't.
They restricted access to an insanely exclusive ecosystem of just 40 partners. We are talking the absolute highest echelons of corporate America. JP Morgan, major tech firms, the real heavy hitters.
And the strategy behind restricting access to a mere 40 partners is, it's a masterclass in building structural moats.
How so?
By limiting the deployment of the Mythos model to this elite group of institutional partners, Anthropic is engineering incredibly high switching costs.
Okay, walk me through that.
Well, if your organization is a massive financial institution like JP Morgan, and your entire risk modeling and cybersecurity infrastructure becomes deeply intertwined with the Mythos architecture, you cannot easily swap it out for a cheaper competitor a year from now.
Right, it's too embedded.
You are structurally locked into that ecosystem, which gives Anthropic virtually unlimited pricing power moving forward.
Okay, but here is where I have to push back a little bit.
Sure.
Let's look at the actual fallout from this Mythos launch over the past few weeks. The reporting shows that Treasury Secretary Bessent, Federal Reserve Chair Jerome Powell, and a group of Wall Street CEOs held an urgent, highly classified meeting specifically regarding this AI model.
They did.
And the phrase they used to describe it in that meeting was a cyber threat. Now, if you are an investor sitting at home right now and you hear that the Federal Reserve and the Treasury Department are treating your portfolio's biggest asset like an urgent systemic cybersecurity threat, your instinct is probably to panic.
Oh, absolutely.
How on earth is a government panic a bullish signal for wealth building?
I get it. On the surface, the optics are definitely alarming. But if we analyze how private valuations are historically constructed, regulatory panic of this magnitude is actually the ultimate form of market validation.
Wait, validation?
Yes. Think about it. Central bankers and Treasury secretaries do not clear their calendars for emergency meetings with Wall Street CEOs over a piece of mediocre, easily replaceable software.
True. They've got better things to do.
They convene those meetings when a technology is so overwhelmingly powerful, so deeply embedded, and so highly advanced that it has suddenly become systemically important to the global financial infrastructure.
I see the angle. It's almost like a private company building a bank vault so impenetrable and so complex that the federal government suddenly demands to know the blueprints because they are just terrified of what happens if they don't control it.
That's a great way to put it. The panic proves, without a shadow of a doubt, that Anthropic has successfully built a Tier 1 technology.
Right.
This level of intense, high-stakes government and institutional attention is the exact catalyst that precedes massive valuation markups in private markets. The regulation itself and the sheer defensive capability required to manage and secure this tech that becomes the moat.
Because it raises the barrier to entry.
Exactly. A group of brilliant engineers cannot just build a competitor to Mythos in a garage anymore, because the barrier to entry now involves coordinating compliance with the Federal Reserve and the Treasury Department.
And Anthropic is really leaning into that defense, right? I mean, they aren't just letting the government panic. They actually launched something called Project Glasswing.
Yes, Project Glasswing.
This is this massive cybersecurity initiative where they're partnering directly with Microsoft, Google, and JP Morgan to harden these systems. They are actively cementing themselves into the foundational layer of global enterprise security. So the defense literally becomes the product.
Precisely. Integrating directly with the likes of Microsoft and Google to secure the model, it proves they're the indispensable core of the new tech stack. They are actively making themselves too important to fail.
Wow. Okay, so we have this incredibly scarce, systemically validated asset locked up inside the fund. But I want to zoom out for a second and look at the broader market psychology right now.
Let's zoom out.
Because the sheer desperation from investors trying to get their hands on private tech, it goes way beyond just AI. We are seeing this exact same dynamic play out in the other massive sector this fund covers, which is space exploration, specifically the crazy gravity around companies like SpaceX.
Oh, the timeline of commercial space exploration is mimicking the AI trajectory almost perfectly.
Really?
Yeah. Just as Anthropic is building the invisible software infrastructure of the future, SpaceX is building the physical, low Earth orbit infrastructure.
The picks and shovels.
Both are the ultimate picks and shovels. And just like with AI, retail investors are completely locked out of the primary wealth creation phase of the space economy.
And it creates this massive psychological pressure cooker.
How do you mean?
Well, in the public markets, pressure releases every day, right? If a company announces great earnings, the stock goes up, people sell to take profits, and the price finds a natural equilibrium. But in the private markets, there's no daily liquidity to release the steam.
Right, the shares are locked up.
So the structural demand from retail and institutional investors just builds and builds. Look at the recent momentum around the new ETF that managed to secure just a fractional holding in SpaceX.
Oh, the premium on that is wild.
It is. The retail demand for private space exposure is so intense that vehicles offering even a tiny sliver of it are trading at massive premiums compared to their actual underlying net asset value.
And the behavioral flow there is just fascinating to watch. Institutions are actively scrambling to engineer complex financial wrappers just to get a piece of this action.
Yeah, they're desperate.
When you see Wall Street bending over backward to create secondary access points for retail capital, it validates the extreme exclusivity of the asset class. And because we don't have a daily ticker to track this fund, that massive pent-up demand is honestly the closest thing we have to tracking the momentum.
Right. And when you have a pressure cooker, any sudden release of steam is going to be pretty violent. Which brings us to the speculative catalysts.
The IPO rumors.
Exactly. The market is currently floating all these unconfirmed rumors about a potential OpenAI ITO or perhaps an Anthropic direct listing down the line. And let's explain that for a second. In a traditional IPO, new shares are created and sold. In a direct listing, a private company simply floats its existing private shares onto the public exchange.
Right.
If any kind of liquidity event like that actually materializes, that is the valve releasing on the pressure cooker.
And it would be explosive. A liquidity event for any of these mega unicorns would force an immediate, dramatic repricing of the fund's currently illiquid holdings.
Because the public finally gets to weigh in.
Right. When a private company goes public, the market finally gets to assign a liquid real-time value to it. And given the extreme structural demand we just discussed, that public market value usually reflects all that pent-up desperation.
So the NAV would shoot up?
Exactly. For an interval fund holding those pre-IPO shares at an older private valuation, a public listing translates into a massive overnight expansion of their net asset value. The independent valuation committee no longer has to guess, based on funding rounds. The public market prints a price that is often exponentially higher.
Okay, so we've covered the upside, the VIP access, the systemic validation, the explosive potential of liquidity events, but we really have to look objectively at the actual risks here.
Fair enough.
Nothing in the financial world is a guaranteed win. There are very real systemic threats that could derail this entire strategy.
So let's look at the catalyst calendar for the next 90 days. What are the major hurdles we need to watch?
There are really three critical factors converging over the next 3 months. First, we're watching the standard quarterly NAV updates from the fund itself.
Right.
Given the release of the Anthropic Mythos model, the subsequent institutional integration, and any fresh funding rounds, the market fully expects to see significant upward revisions in those internal numbers.
Makes sense. What's the second factor? Second, we must monitor the macro environment, specifically the Federal Reserve's interest rate policy. The market is currently anticipating a dovish pivot.
Let's contextualize that for the listener really quick. A dovish pivot means the Federal Reserve is actively lowering interest rates. And when borrowing money becomes cheaper, it disproportionately benefits long-duration, venture growth assets like AI and space.
Exactly.
Because these companies require billions of dollars in capital expenditure to build data centers and rockets. Cheaper debt fuels that tech expansion much faster.
The cost of capital is everything for these frontiers. And alongside the rate cuts, the macro environment is currently benefiting from what analysts are calling yarn optimism.
Right, the geopolitical side.
Yeah, we're seeing an easing of geopolitical tensions in the Middle East. When the threat of conflict drops, the risk premium attached to the price of oil drops right along with it.
And that frees up capital.
It does. Capital that was hiding defensively in energy and commodities suddenly flows back out, and it rotates directly into high-growth technology sectors. This macro tailwind provides incredibly supportive liquidity for private market valuations.
Okay, so if the macro environment and the quarterly NAV updates are the first two things on the calendar,
Yeah.
the third has to be the 90-day progress report on Project Glasswing.
Right.
Yes.
Because Anthropic needs to prove they are actually fixing the vulnerabilities that caused the Treasury Department to panic in the first place.
The Glasswing progress report is the ultimate litmus test right now.
Hmm.
Anthropic must demonstrably prove they are actively and successfully patching zero-day vulnerabilities in the Mythos architecture.
And if they do?
If they can show the government and their elite corporate partners that they have secured the perimeter, it completely validates their commercial viability. It permanently cements their pricing power.
But let's address the elephant in the room regarding the bear case. We talked about regulatory validation, but there is also regulatory punishment.
Yes, there is. The Department of Defense has officially slapped Anthropic with a supply chain risk blacklisting. And just recently, a federal appeals court outright denied Anthropic's request to block that blacklisting. I mean, that sounds like a catastrophic blow to a company trying to be the foundational, trusted layer of artificial intelligence.
It's a severe risk, absolutely.
Yeah.
And it speaks directly to the cybersecurity contagion threat we mentioned earlier.
Right.
The Mythos model is so deeply integrated that if a major bank or a government agency were successfully hacked through a vulnerability in Anthropic's code, the ensuing panic could cause private valuations across the entire AI sector to just drop sharply.
But there's a flip side to this DoD ban, isn't there?
There is. It's a fascinating mitigation dynamic playing out right now. Analysts are referring to it as the forbidden fruit dynamic.
The forbidden fruit, I like that. Break down how that works in practice.
So even though the Department of Defense officially blacklisted Anthropic over those supply chain risks, internal reporting shows that various military branches and defense agencies are actually still being forced to use Anthropic's Claude AI out of pure operational necessity.
Wait, really? The military's still using it?
Yeah. The technology is simply too far ahead of legacy systems. The data analysis capabilities are so deeply integrated into their modern workflows that unplugging Anthropic would create an immediate tactical disadvantage. So, despite the official ban, the usage continues behind the scenes.
That is wild. The government is essentially saying, we are officially banning you because you're a risk, but we still desperately need to use your product to even function.
Exactly. And the irony is it actually increases the scarcity value of the asset.
How so?
Well, it proves that even the United States military, with its essentially unlimited budget, cannot easily pivot away from this ecosystem once it is embedded. And Anthropic is fully aware of the contagion risk, which is why they've committed $100 million in credits specifically to help their partners secure their own systems against any vulnerabilities the Mythos model might introduce. They are turning the government's defense requirement into their own impenetrable economic moat.
This brings up a really tough practical question for the listener, though. If you are an everyday investor looking at this opportunity, how do you balance the structural mechanics of an interval fund against the risk of a black swan event?
It's the million-dollar question.
Because if the Mythos model causes a massive systemic cybersecurity failure tomorrow, those private valuations could plummet overnight. But because of the interval fund's 5% liquidation cap, the stowaway we talked about, you wouldn't be able to just hit sell and liquidate your entire position on a Tuesday morning to stop the bleeding like you could with a normal public stock.
Right. That is the fundamental defining trade-off of private market investing. And every investor has to weigh that reality for themselves. You are explicitly trading immediate daily liquidity for access to exponential pre-public growth.
It's the cost of admission.
It is. The lockup period, that 5% cap, is the strict price of admission to the VIP club. If you're an investor who requires immediate access to your capital, or, if you panic during volatility, an interval fund is structurally the wrong vehicle for your portfolio.
That makes total sense.
The risk of a cybersecurity event is already priced into the scarcity of the asset. When you buy into this fund, you are betting that the structural moat Anthropic is building with JP Morgan and Microsoft will hold up against those threats over a multi-year horizon.
It really requires a completely different psychological mindset. You aren't day trading. You're taking a multi-year stake in the architecture of the future.
Exactly.
So bringing this all together into a definitive, actionable thesis for the listener's wealth-building strategy, where do we ultimately land on the Fundrise Innovation Fund?
Synthesizing everything we've analyzed today, the structural advantages of the interval fund, the unparalleled market validation of the Anthropic Mythos model, the mirroring trajectory of the space exploration sector, and the immense institutional momentum building behind private tech. The final verdict is a highly confident 9 out of 10 bullish score.
A 9 out of 10. That is serious conviction. Let's give the listener the final elevator pitch.
The elevator pitch is straightforward. The fund currently offers the only liquid, accessible avenue for retail investors to own the foundational picks and shovels of the artificial intelligence and space frontiers before they are repriced by the public markets.
Right.
The recent regulatory panic over the Mythos launch definitively proves that these assets are systemic, Tier 1 technologies capable of commanding massive valuation premiums.
Despite the risks?
Yes. While there are undeniable regulatory hurdles and liquidity constraints, the underlying portfolio represents absolute scarcity in a market desperate for growth.
Yeah.
But it requires a multi-year hold target horizon. You have to be willing to sit patiently through the private funding rounds, waiting for the pre-IPO markups and the eventual massive liquidity events.
Sitting back and looking at the sheer scale of the technologies we've unpacked today, it really leaves me with one lingering thought to end on. We are watching the most systemic, world-altering technologies in human history being developed right in front of us. But the most explosive valuation games, like the true life-changing wealth creation, is being completely locked up in private markets, walled off among an elite group of 40 corporate partners and venture capital funds.
It's a profound shift.
It is. If everyday retail investors now need to rely on specialized interval funds just to peek over that wall and get a piece of the action, what does that mean for the future of everyday wealth building? Are traditional public stock exchanges slowly becoming just the after-party for wealth creation, where retail investors are only invited to buy in after the real money has already been made by the VIPs? Something to think about. Thanks for joining us.